guys, welcome back to the Capital Mindset Show. Today we're going to be looking at Carnival Cruise Line. So a bunch of you have been requesting Carnival Cruise Line. I think I understand why, because there's the potential for, the getting back out there trade. And so again, as always, we'll begin with the price action, kind of have some discussion about that. What's going on right now? They're up about like 5% today at the time of making this video. Let's see that. Yeah, like 4.79% over the course of the last 5 years, abysmal performance, understandably because of COVID-19. We see about 83% drop. Congratulations if you bought there. I feel sorry for you if you bought here for now. But however, we want to actually look into the future to see what do we presume will occur, right, throughout the next coming years, right? Will they recover to the same degree? Will they not? Let's see. Okay, so when we get to the we'll cover a little bit, by the way, RCL or Royal Caribbean, and we won't cover Norwegian, but there is a video I have on the channel already on all three cruise lines. But again, today's going to be focusing on Carnival. So looking at the financial statements, we see again revenue destruction, of course, it's to be expected. And we do see on the balance sheet some balance sheet destruction in the form of increased debt. And the cash flows, we are noticing, of course, negative cash flows. They had to continuously expense on purchases of new property, plant, and equipment. And I accidentally said the word expense. No, they actually spent money on it. So it's not like a accrual expense. So yeah, that's pretty much what we can kind of highlight there. I just want to highlight, again, the destruction of the balance sheet. They probably diluted a ton, issued a bunch of shares. So not ideal for this business, but oh well. And let's actually go over here to the model and let's change this over to CCL, see what the analysts say, and then just go off of what the analysts say. I'm just kidding. All right. So just to be real quick. Okay. So we see that it's a $32 price target implying 66.37% upside. That's what the analysts say. Go for the analysts, I guess. And let's change this over to a 10% to say market average rate of return. Let's actually go over here and see what's up. So just to reiterate what this is. So this is a little tool that I'm making just to help us out. So basically I'm saying that we're going to recover in year 2, and I'm just rounding it up or down. And then we want to see, okay, well, from that, what's the cash flows I think they could recover to? Okay. And then from there, we see an average margin of about 12.05%. So we're going to go back here and let's make sure that they end up doing that. All right. So 12, let's change that to 12%. And then from there, what else do we want to do? Well, we have a year 2, probability yes. And if we take a look back here, okay, we want to imply somewhere in the 30% to imply the recovery. So we're already there. So based off of that assumption, it's already in the buy range if this is what you're looking to make, which again, if you're looking for a margin of safety, we're not there yet. We were just there for this high end growth rate. Okay. But again, there's been some incredible destruction in terms of value. Again, in the form of increased debt, we can see that there. And again, the model's kind of weary about this company, according to the Altman Z-score and the company's, the model's own metric there. Analysts don't even expect this to be profitable next year on a cash flow basis. So we're assuming they're profitable next year, and we're being very generous with that, by the way. And we can see here again, shares outstanding. So they have diluted you quite a bit. So that's again, adding to that value destruction story that I'm kind of saying. So a lot of concerns here. I did assume in this model that they're going to do a buyback of about 1% per year. I'm being a bit generous there, but sentiment level is almost positive. It's pretty good. It's not bad. And again, yeah, we have the analysts having their price target. Just in case you guys wanted to see this, here's the management team. But I actually want to showcase to you guys why RCL may not be that much better, if not worse. Royal Caribbean Cruise Line. We can see here similar price performance in the past 5 years, not as bad. So the reason why it's not as bad is they actually were able to help their balance sheet a little bit better than Carnival. And I think we can show that here in the ratios for sure. So ratios, we would see that down here. Total debt ratio rose from 59% to 73% to 84% now. Long-term debt ratio went up to 59%, so basically doubled. And if we actually go back and say, okay, I want to call back CCL to take a look at their ratios. Let's see what happens when it changes. waiting. Okay, so I think it's already changed. And okay, so here's a little bit of a surprise, at least for me, the long-term debt ratio. So I scratched that. You see, this is why I do things live and I like to look at it. So the presumption actually was that Carnival was a little bit worse off, but no, Royal Caribbean actually had more destruction. So that should show up when we do the analysis. So let's reiterate. So at 10%, these are the assumptions. All right, so let's keep all the assumptions the same and kind of just see what happens with Royal Caribbean. All right, so Royal Caribbean, more or less, but still a little bit worse actually in its performance or its outcome. Yeah, definitely not good in this front too. And then I think the similar things here. And then let's actually see this. So, well, here is actually what I wanted. Average buybacks. Wow, that's actually really interesting. So, but that's only taking into account these most recent years. So more recently, yes, but over the longer period of time, it's fine. So more recently, it's been pretty bad, right? Especially when compared to Carnival, actually. So quite interesting there in terms of the valuation prospects. So what I'm kind of showing here is that the cruise lines, yeah, they're very cheap, or they look cheap compared to, previous price actions. So, if we take a look here, they were trading at 133. And then some people say, well, 133, it's 78 now, it must be a buy. Well, not necessarily, because you have to consider the destruction of value that occurred during this time period when the business was not doing so well, right? You don't just delete that destruction of value. That destruction of value went somewhere. The pain just was felt in the balance sheet or the amount of shares outstanding. So the future value, the total future value of this business has come down a bit. That doesn't mean it's worthless at all. By no stretch of the imagination. It just means it's not what a lot of people might think it is. All right. So that's the cautionary note. These two stocks could trade up on a little bit of exuberance, on a little bit of optimism. So it could be, again, price action is basically or practically unpredictable depending on the sentiment of the market and how they feel towards these assets. But over the longer periods of time, the market's not really a voting machine, it's a weighing machine. And so I'd be a little bit more cautious on these. I won't be investing in any of these cruise lines. I personally have a different way to kind of play out the recreational side of the economy. I wouldn't be doing it through cruise lines, but that's just me. All right. On that note, guys, I hope you guys enjoyed this video. If you guys did, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe, and then you come back to the show, and then we might be talking about a stock you're looking into, and then I can provide some perspective that you might have wanted, might not have wanted. I don't know. All right, guys. On that note, I'll see you guys on the next one. Bye.